How do you plan to protect your family if something unfortunate happens to you? Welcome everyone to another edition of the Highball Advisors Railroad Retirement Whiteboard. My name is John McNamara of Highball Advisors, and today we're going to just talk about protecting the family. It's not that exciting. It's an insurance-based video, but one of those things, once again, it's got to get done. You just have to get done because you have other people counting on you. So we have to think about how we're going to protect the family if something happens to you. All right, so what I'm talking about is life insurance. So this is kind of a primer, get you thinking about it, right? And start doing some research on it if you don't feel that you're have the right amount or still concerned about it. So just some key takeaways determining on life insurance, some things you can learn about, right? So it all depends upon your financial and family situation, right? So to give you an idea, like if you're just a single person and there's, at that point in your life, there's, something happens, there's no financial downfall from that, then maybe you don't need the life insurance at that point. But let's say if you're in your 40s and you have 3 kids and all that, and people are counting it, well then, hey, you got to take care of that. So those are the things you want to think about. Which is kind of funny in that it's cheaper when you're younger, and when you're younger, not as many people are relying on you, right? Young and carefree, so to speak. And then it's expensive when you get older and you start getting more responsibilities and things like that, and you start growing wealth, right? Power of compounding. So it's a little more expensive when you get older, and also obviously you're getting closer to your end date, so to speak. So insurance companies don't like to pay out, so they're going to make you pay for it. It's going to get more expensive. All right, and then, what do I need this life insurance for? It's to, pay debts, right? Things that you're going to leave behind, debts, mortgages, student loans, anything else that you have to take care of. So that's kind of some of the key takeaways. Now, there's 2 types of life insurance that you should be made aware of. One is whole life, which is really life insurance. They call it permanent insurance because it's always there. As long as you keep funding it, right, because you got to keep paying the premiums, whole life will be there. So that's insurance, and then there's an investment component with that. Now I put that in red because I'm not a fan of it, right? If I want insurance. If I want investments, I'll do investments. If I want insurance, I'll do insurance. That's kind of the way I look at it. But some people like the whole life insurance. To each his own. Now the other is term life, right? So that's just a fixed amount of time. So you can buy it in 10 years. I'll have term life insurance, 15 years, 20 years. And a good way to look at term life is maybe I'll buy enough to get me to retirement. And then at that point, right, I'll have enough with my railroad retirement annuity. Something happens to me, I have a survivor annuity. So just the term life will be enough to get me there to protect their family. So, and term life is historically pretty cheap right now, so that's something to think about. So how much insurance do you need, right? So the way you want to look at it is what's my debt, right? I might have a mortgage. Let's say you have a $200,000 mortgage. Well, I want to saddle my family with that. I don't want them to move out, so I got to pay for that. Income replacement, right? So you want to think about 10 times. So simple math, if I make $100,000 a year, right, 10 times, I need $1 million worth of life insurance there. Okay, and then, obviously if you're also insuring others, for whatever they're doing, colleges and things like that. So those are the type of things you want to be thinking about that. Now, what I said, remember, you could do the term life, your company probably. I think most companies do about 2.5 times their income. So so you could take that off right there, and that leaves you at 7.5. So something to think about there. So the way I look at it is, this is a good method, the standard living method they call it. So to maintain your family's standard of living, figure out what that is, right? So let's say if it's a $50,000 a year, we'll say, right? We'll make this $50,000. That's my mistake. $50,000 times 20, right? 50,000 times 20, so that's $1 million. Right? I need $1 million worth of insurance. Okay, then 5% withdrawal of that every year of that $1 million is $50,000, And then so you have a balance of $950,000 obviously after the first year, and then you invest that, and that can keep growing, and you'll always be able to fund that that standard of living there for 20 years. So that's one way to look at it. There's a lot of different other ways to do it, but the key point is start thinking about what you need in the life insurance, right? Just add up the debts and that you're going to have to pay if something unfortunate happens to you. Understand what your family financial situation is, right? To maintain that standard of living, and then back yourself into an insurance number. So I hope you found this video helpful. I know it's very important, so definitely go through this. You know, just sit down, spend the 15 minutes. All right. If you're at or near retirement and want to go through my Boarding for Railroad retirement process, please do reach out to me. Sign up for that. It's good stuff for you. And then everyone, until next time, please stay safe, stay on track. Take care. So long, everybody.